Hey there, everybody. It's Garrett. And today we're going to be talking about one of my favorite index funds, and that's Vanguard's VTSAX. So let's go ahead and get into it. And right here, as you can see, I am on Vanguard's page right here showing VTSAX and all the information about it. Each index fund or ETF, you'll see that Vanguard will give you a nice little page here that kind of breaks down everything about the index fund. So VTSAX is Vanguard's total stock market index fund, admiral shares. So what does that admiral shares mean? It means this stuff right here. You have a $3,000 minimum investment, an expense ratio of 0.04%. So if you don't have $3,000 to invest, don't worry. This will still work for you. As you can see right here, if you switch over the ETF, you go over here, and it's VTI. VTI, it's about the exact same thing as VTSAX, other than the fact that it's an ETF, which means that instead of just being a fund that you can automatically send funds to every month or week, however you set it up, this one instead will kind of trade like a stock. It'll have a little, stock graph, and you can buy it and sell it at different points during the day. But any kind of mutual fund or index fund, you'll buy into it later in the day at 6 p.m. The transaction will go into effect, which is after market hours. So that's the big difference there. Overall, not a huge difference as long as you keep up with it. Also, a little cool thing is the expense ratio is just a tad lower, which overall with this one it's 3 cents they're charging you for every $1,000 you make. So it's not much to begin with, but you're saving a penny for every $1,000 you get, which if you get a lot in here, that might add up. So maybe you want to stick with the ETF, but I'm going to go over the actual index fund to begin with. Right here, you can see what the price is currently. It's currently at $94. It's a little bit down today. Market's kind of been fluctuating a lot with all the GameStop and AMC, Robinhood drama. And right here, this is the important thing though. Not what the performance is doing right now, but what it's been doing in the long run. So here this year, you can see there's big gains, mostly because of the coronavirus in March, dropped everything. This fund in particular was around $50. I purchased a lot into it then, and now it's at $90. My thought process behind that was the market, by the time I'm going to have to retire, is going to well recover from that. Never in a million years would have thought it would have been just like that, but it was. It was just, I think, 90 days-ish before it pretty much recovered back to the pre-pandemic levels. The important thing here is since inception. So this index fund was created November 13th, 2000. So you've had over 20 years of historical data. I think that's a good chunk of data to rely on. Some funds might be less. Maybe it's 10 years, 5 years, 3 years. And normally the thing is, if it has, let's say it has better results right here than VTSAX does, 7.82%. Let's say it's 13%. That looks really good, but you have to keep in mind that that's just 1 year, and you can get lucky. A blind squirrel finds a nut every once in a while. So with that longer data, you see how reliable it is. And if you're investing in VTSAX or any kind of index funds, what you care about is what it does in the long run. This is usually put into retirement accounts. It doesn't have to be, but you can put it into your retirement accounts, and it's a very conservative approach at it, but it also can give you big gains, and it just gives you peace of mind using it, knowing that it is the largest index fund in the world, most people using it, and it's tried and true, and you can just trust it. If you go down here, this kind of gives you more specifics about the index fund itself. Over here, this shows each sector of the economy and how much of a percentage it is of this fund. As you can see, 26.2% for technology is the largest piece of this fund, and the lowest would be basic materials. This kind of makes sense. Tech has usually been very well performing in the last couple decades at least, last 2 decades, ever since the dot-com bubble crash. It's been very good. Obviously, the big names show you this. These are their top 10 assets, which make up a total of 23.3% of the entire portfolio combined. Apple, tech. Microsoft, tech. Amazon, tech. Alphabet or Google, tech. Facebook, tech. Tesla, it's also kind of tech. It's a car company. Berkshire Hathaway, investing company of Warren Buffett's. J&J, JP Morgan, and Visa are the only three on that list, and they're the bottom ones that aren't really tech related, but they all got their foot in the door somewhere with tech. So though it is a big portion of the portfolio, I wouldn't be concerned with it being not diversified enough. I think it's good where these numbers are at. Maybe you want real estate higher. Maybe you think energy is going to be doing really good with Biden coming in, a lot of green energy stuff, new opportunities, I guess, in the market for solar and wind energy. If you want more of that, there's other ETFs and index funds that you can use that maybe focus more on whichever of these sectors that you would like. There's an index fund for just about anything, an ETF as well. So if there's something you want to look more into, it probably exists. So, but I would still recommend having this as the main part of your portfolio, especially for a retirement account. Especially if you're starting off, it's just safe. You don't have to know anything. You don't have to buy 20 different things. All of these companies are all in this. 3,500 companies that this makes up. You don't have to click a button, buy 3,500 times. You do it once. It has just about every name in the stock market when it comes to the U.S. economy. Nothing foreign related, just U.S. If you do want international fund as well, or a combination of global and international, those exist as well. Though I believe more strongly in the United States market and more comfortable with investing in the United States market, as a lot of people are. But usually it's recommended that you have at least a little bit of a international diversification in your portfolio. Though if you don't, I wouldn't stress out about it too much. The risk potential is a 4 out of 5. I'm not sure why it's that high, but if you're a younger investor, this doesn't mean that, oh, there's a good chance you lose all of this. It just means it'll be a little bit more volatile, go really high, go really low, really high, really low. And this is actually fine and even recommended for younger investors. If you're investing for at least 10 or more years, which if you're around my age, you're in your 20s or your 30s, you're going to be having this on your portfolio for at least probably another 40, 50 years. So that's not a big deal. And this will likely give you better returns in the long run. Where this comes into being a problem is if you're investing in the short term and you want these returns pretty safe, you're going to be withdrawing them soon, and then you don't want all that volatility because you might be pulling out when it's at the bottom of the stock market as opposed to deciding, hey, it's at the top, I want to take it out now. Also, forgot to mention this, the total assets of the fund is 1.1 trillion. So yeah, it's pretty big. And also with the index funds, you can purchase not in the number of shares, but you can use a dollar amount, which nowadays platforms like M1 Finance or Robinhood, they'll allow you to buy fractional shares, while some of these bigger companies are a little bit behind on that, like Vanguard. I think they'll change that in the future. I think that won't be an option that they'll be able to resist. But as of now, they don't allow you to do that. Both index funds, you absolutely can with anyone. So if you want to buy $50 a stock of this index fund, you certainly can, even though it's $94.43. You wouldn't have to put $94.43 in to purchase into the fund and get one share of that. You can do it by a dollar amount, so you could own 20.32519 shares of the stock. It doesn't matter. You can buy it in shares if you would like, but most people do a dollar amount. So you might say, I want to put 15% of my income in investments, and let's just say this is the only thing you own. And so you maybe make $100 just to make it easy. So you're putting $15 in. So then you can put $15 in every month, and you don't have to wait until you have that $94 after X number of months. You can right ahead go and buy $15 worth of this, so a fractional share, and then that can start compounding and start making you money, even though you don't have enough for that full share, which is great to have. Overall, this is a great fund. I use it myself. I enjoy it. I think it's a great investment vehicle for both beginners, especially beginners, and even long-term holders, people with big portfolios, lots of money in it. I think this is something you have to have, or at least something similar to it. If you have that $3,000 at least to put down, I would use the Admiral Shares Fund. If you don't, use the ETFs. If you have it within a retirement account, an IRA, a Roth, 401k, whatever it is, you can always sell it with no fees, no capital gains if it's inside those accounts, and just buy right into the Admiral shares. So whichever way you do it, it's a great option. I couldn't recommend it high enough. I'd give it a 10 out of 10. I enjoy it. It is the biggest part of my investment retirement portfolio. And I just want to share that with all you guys because I think everyone should take advantage of this. Now, if you enjoyed this video, learned anything at all, I hope I helped you. And if you could please give me a like, maybe a follow, leave a comment. I would enjoy to answer any of your questions you guys have. And have a good day. Thank you.